In a bold stance, Federal Reserve Board Gov. Christopher Waller dismisses the recent benign consumer inflation data and calls for 2 more interest rate hikes this year. He emphasizes the need to keep inflation in check and believes that the target range requires these additional adjustments. Waller acknowledges the positive impact of the cooling CPI data for June, but asserts that a single data point cannot dictate the overall trend. As Waller expresses his confidence in the economy's resilience following the collapse of Silicon Valley Bank, he advocates for the first rate hike to take place later this month. However, market skepticism remains regarding the implementation of a second hike. With the timing of the second increase contingent on future data, Waller maintains that September remains a live meeting. As economists debate the potential consequences of past rate hikes, Waller cautions against holding rates steady, asserting that the bulk of last year's tightening effects have already dissipated. Waller's unwavering stance invites contemplation. Should the Fed prioritize data over a predictable schedule? Will the economy withstand further rate adjustments? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. Federal Reserve Board Governor Christopher Waller stands firm in his position, unswayed by the recent benign consumer inflation data. He firmly advocates for 2 additional 25 basis point rate hikes to be implemented within the remaining meetings this year, citing their necessity to steer inflation towards the target range, with the aim of reaching a benchmark rate between 5.5% and 5.75%. Waller believes these adjustments are crucial despite the welcome news of cooling CPI data for June. He reminds his audience that a single data point cannot be extrapolated into a long-term trend, urging caution and rational decision-making. Addressing concerns surrounding the impact of the Silicon Valley Bank collapse on the economy, Waller expresses increased confidence that the fallout will not pose a significant threat. He goes a step further and proposes that the first of the 2 rate hikes should occur during the upcoming meeting, displaying his determination to maintain stability and control inflation. Derivative market traders have already priced in high probabilities of a rate hike after the forthcoming Federal Reserve meeting. However, doubts linger regarding the likelihood of a second hike even before considering the recent soft CPI data. Waller acknowledges that the timing of the second hike hinges upon forthcoming data. Should inflation fail to demonstrate continued progress, or if there are no indications of a significant economic slowdown, Waller argues that the second 25 basis point hike should occur sooner rather than later. However, he acknowledges that such a decision will be made in due course. During a question and answer session, Waller emphasizes the significance of the September meeting, stating that it is indeed a live meeting during which the Fed could potentially raise rates. A debate among economists centers on whether the Federal Reserve should maintain rates at their current levels through the end of the year, as some officials suggest. They anticipate the economy will experience lagged effects from previous rate hikes. In contrast, Waller asserts that the majority of the effects resulting from last year's tightening measures have already materialized. To pause rates now, under the assumption of awaiting protracted and uncertain lags, would be akin to standing on a train platform waiting for a train that has already departed, according to Waller's metaphorical caution. As the 10-year Treasury note yield declines to 3.77%, following lower than expected job growth in June and a decrease in inflation, Waller's perspectives leave market participants contemplating the future course of action. Will the Federal Reserve prioritize data over a more predictable, mechanical approach to rate adjustments? Can the economy withstand further rate hikes without compromising stability? These thought-provoking questions invite readers to form their opinions on the matter, exploring the potential ramifications for the economic landscape. Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.